All right, so let's take a look at some case studies. Let's tie all this together with some actual real numbers here. I'm going to show you 6% average returns and loans at 5%. I want to show you just what 1% will do for your retirement income. Okay, in this first example, I want to look at a 40-year-old. This is a 40-year-old that is saving $18,000 a year for retirement. Now remember, this is after-tax money. So he's already paid his taxes and he never has to pay them again. Okay? If he does it correctly through loans, they are income tax free in retirement. So he's putting away $18,000 a year after he's paid his taxes, and this is not a requirement. If you have a bad year, if you lose your job, if you have a financial setback, you do not have to pay $18,000 a year. That is the maximum efficient contract. In fact, he can't pay any more than $18,000 a year because he's buying $300,480 of life insurance. I know it's a weird number, but that is to avoid the MEC. The $300,480 is what he has to buy to make the IRS happy and get all the tax benefits. That's the lowest he can get away with. Your numbers will be different, but that's what his numbers are. Now, he's putting away $18,000 a year all the way until retirement. Now, the fees are going to start out high and then they're going to go low. Your interest, I'm showing 6%. You could earn 7 or 8 over time, but this is looking at 6%, okay? As you can see, it takes a few years, well, right around in the fourth year, is when you start to earn more interest than what you're paying in expenses, okay? Your account value starts out in the hole because you put in $18,000, the expenses are higher than the interest, so you start out in the hole. And the insurance company does not give you full access to all of your money. So think of the account value like your house, okay? And think of the available cash value like the equity in your house. It's the amount of money that they're going to give you access to. So you can, and let me make this very clear, you can take out a loan in the first year right away. The day after you make your first payment, if there's money available, you can take a loan. You don't have to wait until you're in retirement. You could use this money as an emergency fund. You could use this money to borrow against it to pay for college. You could use this money as a down payment on a piece of real estate. You could use this money to buy stocks. You could do whatever you want. This is money that you can borrow. This is available to you. But you'll notice that it's not until after the 12th year for this product. Some products it's after 10. This product it's after 12. But that's when you have full access to all of your money. But even though you have access to this money, you are compounding interest on the account value. So the compounding interest is on the big number. And if you were to die, you are going to get the account value plus the life insurance for your death benefit. So your death benefit is the account value and the life insurance, unless you have a loan balance. If you have a loan balance, then the loan balance would get paid off upon death, and that would of course come off of the death benefit. But as long as we don't have a loan balance, your account value and your life insurance equals your death benefit. All income tax free, okay? So your expenses are going to eventually get lower. Your interest, of course, is going up. Your account value, of course, is going up. And all of this is growing income tax free, right? Your available cash value is eventually the same. You have your life insurance. Now, here's the secret. Let's scroll down. Let's scroll down here. Okay. Okay. As we scroll down, you can see that eventually we are going to start borrowing money. Now, I know the headings are a little off on this, but this column is our tax-free policy loans. We're borrowing the money from the insurance company, income tax-free. Okay? There's no capital gains tax, no income tax, the whole 9 yards. Now, here's what I want you to pay attention to. Our account value has grown to $1 million. And we are able to borrow 8% in this estimate. 8%. That is double the retirement income. Now, I know I promised triple the retirement income. That's next. I'm going to show you that one next. But just for starters, we're already at double the retirement income. Why? Because of uninterrupted compounding interest. Let me say it again. Uninterrupted compounding interest. I am not stopping the interest. Now, I've stopped the payments. I'm no longer making any more contributions because I'm retired now. When we retire, we can reduce the insurance. When we're done making payments, we can reduce the insurance. Now, if you only make payments for 5 years or 10 years, you can reduce the insurance after you're done after 5 or 10 years. But in this example, we're making payments all the way until retirement. And now in retirement, our money is still growing. Think of it like taking out a home equity line of credit against your house without a loan payment. Wouldn't that be cool if you could just take out a bunch of home equity line of credits? You could just borrow $80,000 a year off of your house and not have to make any payments on that? Well, that's actually called a reverse mortgage. Again, for people who are older, that's something to consider. Not really what we're going to talk about in this particular video. But my point is that in this life insurance, we are living on $80,000 a year in retirement, income tax free. Income tax free, $80,000 a year off of $1 million. Okay? Now, our available money is going down a little bit, but not much. So it's just like the 4% rule. We're still going to leave money to our kids. In fact, if I scroll down a little bit, let's look at this down here. Let me scroll out just a little bit. Okay. Our total expenses end up being about $300,000. And we've earned an estimated $6 million. $6 million of interest because we never interrupted the compounding interest. Can you imagine if your retirement could compound interest the whole time, the whole 20 or 30 years you're in retirement? How powerful is that? Now, would you pay $300,000 of expenses to earn $6 million of interest? I think so. Your account is over $6 million. We only invested $450,000, or I should say we only saved $450,000. This isn't even technically called an investment because it's guaranteed to never lose. So there's no risk of losing your money. The only thing that is going to come out are the expenses. Now, how are the expenses getting paid if you're not making any more contributions? The expenses come out of your account. As long as there's money in your account, the expenses can be paid. So that's why you could skip payments even in the second, third, fourth, fifth year. You could skip payments and the expenses just come out of your account. Think about it like having a car payment that comes out of your bank account. As long as there's money in your bank account, the car payment can be paid, right? It works the same way. The expenses are technically coming out of the available cash value. You are not required to make these contributions as long as there's money in your account to cover the expenses. Remember, the expenses are the minimum. Remember the minimum line. The expenses are the minimum that the insurance company requires. The $18,000 that I was showing you is the maximum the government will allow in this example. Okay? So, when it's all said and done, and you're laid to rest at 95, your account is at $6 million, but you've borrowed $2.4 million in retirement and you didn't make any loan payments. You didn't make any loan payments. So look at your loan interest. Your loan interest is compounding just like your account value. So remember my green line. My green line goes like this. My red line went like this. The red line was the loan balance. My loan balance is getting bigger at 5%, but my account value is getting bigger at 6%. It's the uninterrupted compounding interest and the 1% difference that is allowing you to double your retirement income. It's the uninterrupted compounding interest that's allowing you to double your retirement income. But the loans are also compounding interest. So when you die, you owe $5.5 million to the insurance company. Where's the insurance company going to get $5.5 million? Out of your $6.4 million. It's just like dying with a mortgage on your house. If you die with a mortgage on your house, the bank's going to take what you owe and give your family what's left, right? Okay, what's left? What's left is almost $1 million, $900,000. Remember, we started with $1 million. We're going to leave our family $900,000 plus a little bit of life insurance for a total of just shy of $1 million. Now that beats the heck out of the 4% rule because that's double the retirement income and it's all income tax free, and the death benefit is also income tax free. Now the death benefit does get added to your estate. So if your estate is in the millions and you could possibly be paying estate taxes, this could be added to your estate for estate tax purposes, but it's all income tax free. Most people aren't running into those estate tax issues anyway. But even if you did, this could definitely help. This could help pay your estate taxes. So anyway, that's how it works. That's how it works. It's that simple, okay?